Okay, so the Fed literally just a few minutes ago made the announcement that they're going to be cutting rates by 0.25%. That brings the range from 4.25 to 4.5 down to 4 to 4.25. They also let us know that there's going to be another two more 25 basis point cuts likely before year end. They were originally expected in early 2025, 26. They're pulling back into 2025. And interestingly, on this policy, there was only one dissenting vote. There were people who expected a lot more than one dissenting vote, maybe as high as four, but there was only one. So, Brent, what would you think this means to investors?
Yeah, this is a pretty widely anticipated decision, but nonetheless, short-term rates on things like bank accounts, savings accounts, and high-yield money markets are likely to drop in tandem with the same 25 basis points. For those of you who are not familiar with basis points, it just means 0.25%. So if your bank accounts were paying 3.5 over the next few weeks, they're likely to drop closer to 3.25. It also means that this does not necessarily mean longer term debt, such as mortgages or car loans, are going to come down with it. It's just that shorter term rates have dropped and longer term rates are still yet to be seen what happens there. Part of the reason for it, the Fed has a dual mandate. There's two things that they have to look for at any given time. One, their goal is to maximize employment. They want to make sure Americans are working. But at the same time, they're also mandated to try to regulate inflation and maintain a reasonably low rise in the standard and the cost of living. So, given that the impact of tariffs from earlier this year and ongoing throughout the summer is still not fully known, they're being cautious, and the rate of decreasing interest rates are normalizing. They're going to stay pretty consistent here at just 25 basis points. Um, they're just hesitant because we want to see what happens to employment and what happens to the economy as we get farther into the year and we see more of the impact of tariffs on our imported goods. Broadly on the stock market, the initial reaction has been fairly muted. We haven't seen a large increase or decrease in the S&P 500, the Dow, the Russell, or any of the other major indexes, at least initially. This could change quickly, but I think partly it's because a lot of this has been priced in. The market has widely anticipated this decision now for a number of weeks, likely anticipated even longer this year. And the stock market in general is at all-time highs already. So it's going to take a little while for the markets to digest this information, but we're now looking for clues as we head into the fourth quarter. The pace of slowing of the economy versus the rate of increase of inflation. And those two will drive Fed decisions going forward.
Okay. Thanks, Brent. So if we're looking at three rate reductions potentially by the end of the year, would you say this is a rate cutting cycle?
It's hard to say that at this moment. And I think the one thing that the Federal Reserve is trying to do is re-inspire confidence in their decisions together, which is likely why you saw only one dissenting vote. But to your point, that's also part of what we're going to be looking for, and specifically the Federal Reserve will be looking for as we get into the fourth quarter, is if we're seeing the economy slow farther and you see more signs of deceleration, they're going to be looking to make this a rate cutting cycle if they see signs of a recession ahead. I think one thing, as the point you may be raising, is that the unemployment numbers have been strongly revised from earlier reports. Nearly 1 million jobs less than anticipated or were initially reported. A number of reasons for that. But as the Federal Reserve is reading those numbers, they're seeing there is now a need to cut rates, but they also want to be balanced between not looking alarmist and making sure they start moving in the right direction.
Right. Great. Thank you, Brent.
Thanks, Damon.